We've come a long way to understand asset and portfolio risk. We saw that we can define assets by their mean return and standard deviation. We can also plot them on a two-dimensional graph for comparison. And by mixing them together in a portfolio, we're able to eliminate some of the uncertainty. So volatility relates to total risk, which has a part that can be diversified and another part that cannot be diversified. Investors should receive a premium for the risk that cannot be diversified. And rational investors should choose portfolios that yield the highest return per unit of risk, meaning the ones that have the highest Sharpe ratio. These portfolios are found along the capital allocation line here. They are a mix of the risky tangency portfolio and the risk-free asset, which is used to calibrate the risk. But all these portfolios here have the highest Sharpe ratio, which is equivalent to the slope of the capital allocation line. Assuming that investors are rational and that we have market equilibrium, there's an important mathematical property of the tangency portfolio which I hadn't mentioned before. Looking at this formula here, we see that the mean return of any portfolio minus the return on the risk-free asset, this is often called the return premium of the portfolio, divided by the covariance of the portfolio with the tangency portfolio, should be equal to the premium paid on the tangency portfolio divided by its variance. The covariance can be calculated by multiplying standard deviation of the portfolio, standard deviation of the tangency portfolio, and correlation of the portfolio with the tangency. We have discussed so far key insights of modern portfolio theory, a finance theory introduced by economist Harry Markowitz in a 1952 essay, and for which, in 1990, he received the Nobel Prize in Economics. Still today, modern portfolio theory is one of the most influential portfolio theories and widely used by institutional investors worldwide. Other scholars have built on the conclusions of modern portfolio theory. One important example derives from the property of the tangency portfolio that I just presented to you. With a little bit of algebra, we can write the equation in this new form here, where the premium of any asset or portfolio is determined by a specific number times the premium on the tangency portfolio. This number is what you probably heard of as beta, and it relates to the systematic risk, the overall economy risk, the part of the volatility that we cannot diversify. We can also plot this equation on a graph where we have beta, systematic risk, here on the x-axis and return on the y-axis. Our equation is represented by a straight line crossing the y-axis here at the risk-free rate. This is a fundamental insight stating that all assets and portfolios should have their returns determined by their systematic risk, which again is the part of the volatility that we cannot diversify. In addition, they should be all lined up on a straight line, called the security tangent line. The more systematic risk an asset has going up on the line, the more return it should give investors. The slope of this line is called the Trainer ratio, and it should be a constant. If we find assets in the market that are delivering higher returns than expected, meaning they're here above the security tangent line, they're probably undervalued. There's an additional return that we would gain by investing in it. Whereas assets that deliver a lower return than expected here below the security tangent line are probably overvalued and not delivering enough return for their risk. This insight is what we know as the capital asset pricing model, created by many who worked on it around the same time. Some of these scholars also won the Nobel Prize of Economics in 1990. The CAPM had a major influence on how we value assets in the market, from private companies to public stocks, and it's still widely used today.